we're doing Warren Buffett tonight. We're doing Warren Buffett because at the Berkshire Hathaway AGM earlier in the year, he announced his retirement, which is, it's a big deal. It really is a big deal. As investors, he has become sort of the icon for successful, prudent, and in a way, boring and simple investing. And I think that's what we're going to find in this evening's presentation. I've left time at the end for questions, but I think one of the themes that is going to come through at the end is you're going to think to yourself, there's no rocket science here. And I think that's at the core of what investing is. I think we overcomplicate it, and that's a human trait, and we can talk about that a bunch as well. But really, at its core, investing is buying quality at good prices and letting time do its work. Tomorrow, I'm at the JSC. I'm the keynote for the Schools Challenge prize giving, and I always say to the kids that they've got two things which most people don't have. The one is they've got knowledge about the markets because they're the winners of the Schools Challenge, and perhaps more importantly, they're teenagers. They've got decades, and that time is our biggest asset as investors. And I can see some of the folks who are slightly older like me giving me side eyes, but it is it is how it works. So Warren Buffett, born in 1931, Omaha, Nebraska, still lives in Omaha, still lives in the house he bought in the 60s. Age 14, he had to file his first tax return because he was making money from his newspaper delivery, and he had pinball machines which he used to stick into various parts around the world. He worked for his father's firm as an investment salesman for a couple of years, and then importantly, he joined Graham Newman Corp. The Graham being Benjamin Graham, intelligent investor. I'll come to that in a second. In 56, he starts investment partnerships. Basically, that's friends, family, sort of investing their money on their behalf in a partnership. And then in 65, he makes what's probably one of his biggest investment errors. He buys Berkshire Hathaway. It is a textile company. He thinks he can turn it around. He doesn't. The Berkshire Hathaway textile business is an absolute horror of a business, and ultimately they shut it down. He becomes CEO and chairman in 1970, and that's also when he starts with his annual letters. Every year with results, he writes an annual letter. There are 44 of them at this point. I'll give you the link in a moment. They are typically fairly short, 8 or 10 pages, and they are worth every minute of the read, even the very old ones, because this is how we understand his thinking. Today, I'm going to have lots of quotes from Warren Buffett, but the core point is understanding his thinking, which is around those investment letters. And one of them, which I'm not going to delve into deep today, but which he talks about a lot during the letters, we will make mistakes. We will make mistakes. Berkshire Hathaway was a mistake. It was a terrible business he bought. He sold that out, and now he's using the rest. You want more volume there? Less volume there. He sold it out. But he keeps on coming back to the point that we will make mistakes. That is inevitable. His response to mistakes is quite simple. Admit it, exit it, and move on. Don't expect a life, whether it be career, whatever, health, investment. There are going to be errors in it. The point is to move on, to accept it, not to fight it, not to pretend it isn't. I've written about this before, and this will resonate with some of you. You log on to your online share trading account, but you kind of don't look at the portfolio because there's that one stock there you wish wasn't there. That one that had lots of hope and promise, and now it's sitting there at like 10 cents with a big minus. And my advice to you is tomorrow morning at 11:15, sell it. Why 11:15? Because it's a random time. But you know what? Every time you log in, it's causing you that jolt of pain. Get rid of it. Remove the pain. If you had a splinter in your foot, you would sit down and take it out. That's a splinter. Get rid of the dogs. We love dogs, but not in our portfolios. They have a place, not in our portfolios. It was 85 before they eventually gave up on their textile operations. So 20 years of struggling with it. And he talks about it a lot in the letter that year. And he says, you know what? It really, really was a mess. But their big investment was 1976. They bought a significant stake in Geico. It is a short-term insurer. I'll touch in a moment on why that's hugely important. That is their share price. My history doesn't go far enough back. We'll get your numbers in a moment. The A shares are $738,000 per share because he doesn't do share splits. He also doesn't do dividends. More volume. We can have plenty more volume. So he doesn't do share. There are B shares which we can buy which are cheaper. BerkshireHathaway.com. If you want to see a website from the 90s, go look at that thing, man. It is 90s. There is nothing flashy about it. And that's where you'll find all the letters. And that's his performance. 1965 to 2024, the S&P did 10.4% a year in dollars. Not bad, including dividends. He did 19.9% per year. So he only beats it by 9.5%. But over that period, S&P grew 39,000% and Berkshire's NAV grew 5.5 million percent. The outperformance, I mean, I can't do the math. It's, the outperformance is insane just by doing that repeated compound. Now, some years he beats the S&P, some years the S&P beats him, but it's that long-term sustained beating of the market by, truthfully, I mean, a 9% beat. I mean, I made light of it. It's a big number. It is absolutely a big number. Make no mistake about that. But look, I mean, if he just did 15, he probably would have only done 1 million percent growth, still beating the S&P's 39,000. To be clear, 39,000 return over the period isn't bad either. Not shabby. That's just going by an S&P 500 ETF. The secret? Time. Loads and loads of time. Tons of time. More than anything. Some key points from Buffett. So he started as a value investor. Remember I pointed out he was working with Benjamin Graham, who wrote the Intelligent Investor. That is the book on value investing. I warn you, drink it with a glass of water because it is a dry book. And in there, it gives you the two formulas that Benjamin Graham uses to find value stocks. Every time I run it on the JSE, the number of shares that come up is 0. But there are a few in the US. But the key point is Warren Buffett started as a value investor and then moved away from that. He became what I call generally GARP, growth at reasonable price, which is very much more sort of Phil Fisher, Peter Lynch style of investing. They were writing books in the 70s and 80s around investing, and that's that growth at reasonable price. I would argue that more recently, and by that I mean the last 20 years maybe, he's become what I would call an opportunistic investor. And what I mean by that is in the 2008 crisis, he was lending banks money, but being Warren Buffett, he didn't lend them money. He bought preference shares that had a guaranteed 10% return. And I mean, he structured deals. He's like, your bank's going bust. I've got the money, but the terms are mine. And so he became much more of an opportunistic investor. The Geico investment for him was crucial because it gave him float. Insurance companies, how do they work? Well, so you take insurance, your life, your car, whatever, and you pay them premium every month, and then one day, eventually, you claim. But between paying the premium and the claim, they've got that money and they invest it, typically in the stock market. So he had access to that cash that Geico had. And he could use that to go and buy Coca-Cola, Amex, and all the rest, and slowly build his portfolio up. So that was hugely important. We're unlikely to buy a Geico, and in fact, the new rules that are out under Basel III, which came in post the 08-09 global financial crisis, insurers don't have quite that level. But you'll see it in our insurance companies at the moment as they're reporting results. Sometimes Sanlam, Old Mutual, all of them, they're doing really great. Why? Because all those shares that they hold, thanks to your premiums, well, the market's up 20%. So they're up 20%, and they book it as profit. Thank you for playing. Insurance is a great business if you do the math right. If your underwriters aren't on top, you're in trouble. His problem now is size. He's just too big. 350 odd billion in cash. You know, he's buying into a company called Pool Corp in America. They literally make swimming pools. But Pool Corp is only like a 10 billion company, which in of itself is staggering that a company that cleans and makes pools can be worth 10 billion. But, you know, he goes and he buys a little bit, but it doesn't make a dent in his giant cash pile. He's just, I think, got too big, and he won't pay dividends. We'll come to that in a moment. So there's been an evolution over time, but at the heart of what he does, I think still works and still applies. So we're going to go through a bunch of his better known quotes and detail those. Price is what you pay, value is what you get. Probably, I think, his best known quote. And what it's essentially saying to them is market price is not business value. The market, and Charlie Munger, his colleague who passed away 2 years ago, Charlie Munger would tell you, that the market is a manic depressive. And sometimes it wakes up all excited and it goes up, and the next day it wakes up all depressed and it goes down. And if you've looked at markets over the last year, we know exactly that that story is fundamentally true. What matters is that business value, and that business value is cash flows, is business model. How does it make money? What are its prospects of making money? In other words, understand what you're buying and then focus on the business worth, not the stock moves. What's the actual, Warren Buffett uses the phrase intrinsic value a lot. And there's a lot of different ways to sum up intrinsic value. You can, in some cases, just use the net asset value of a business. In other words, if you liquidated it, what's it worth? I don't think that's a fair reflection, because most businesses are worth more than their breakup value because they're making profits. Although, fun fact, Nedbank and ABSA both trade below their net asset value, which makes no sense. And earlier in the year, back in April, so did Standard Bank. And you got to ask yourself, when Standard Bank was on a price to book of 0.9, that just seemed wrong. Standard Bank makes money. They should be worth more than their liquidated value. So he's looking at that sort of thing. I'm going to show you some concepts I've got for determining that value. The key point is, why are we buying a business? Cash flow. Every business's core rationale for existing is to generate cash. And that's what businesses matter. And so you could go and do something like a DCF, a discount cash flow model. You can do a Gordon dividend model. You could just look at dividends. You could just look at free cash flow per share. You can look at any of those to get a sense of how the business does. But to me, it's always a case of what I would like at a results statement is I want in that results release a copy of their last bank statement. Just like show me how much cash came in, how much cash came out, and how much cash is left. Like that would tell me a ton of stuff. Instead, I got to go to the cash flow statement and read all the stuff and try and understand it, etc. But it is ultimately cash. It's also avoid chasing. There's only, in the investment world, I suppose there's two decisions. What are we going to buy? And then the second point, at what price do we buy? That's all we control. Once you've bought a stock, price is going to go up, it's going to go down, earnings are going to be good or bad, dividends will flow, they won't flow, whatever the case may be. The thing is, you don't have control over that. And even when you eventually decide to sell, you don't have control of the price. Yes, you can say, I'll take that price on offer, but you can't say, my share I want to sell for 500 if everyone is saying, hey, dude, we're buying for 100. You're basically going to take the price the market has got for you. So the price that we pay so matters. And we need to guard that and be protective of it and say, I like this company, but I want it at that price. And the market gives us opportunities. You could have picked up Standard Bank back in April at a price to book of 0.9. Now it's about 1.4. So you're up, I don't know, 50% or so since April. With respect to Standard Bank, who's paying for today, it's a bank, it's boring. But you got it at a good price, rather than buying it, I don't know, I'm trying to think, at some point it was probably at a price of book of 1.8. Now you're still buying the same bank, but you're paying 2x for it. Why? Why pay 2x? Why go into the dealership, motor dealership, and say, I like your car, but I want to pay more? No, man, you wait for them to be having a sale. And then you go in and then you try to negotiate them lower still. That price you pay matters, and we need to be exceedingly strict around it. And I want to make a quick proviso on that. I'm talking individual equities here. ETFs, I don't really mind. I have a debit order, goes every month, buys me ETFs. High price, low price, I buy the ETF. What I will do is if markets are down 20%, I will try and double my debit order. In other words, catch on that slightly lower price. So if there's been a 20% correction, as we saw, we didn't quite get there back in April, but we certainly got there in the pandemic when markets were crashing in March and April of 2020. I doubled my purchase value because I'm like, markets are down 20%. Is it going to fall 50? Maybe, but 20% down, it's Woolies having a sale on their chickens. This is also in part why Buffett sits on so much cash, because he can't find what he likes at a price that he likes. But then something happens. A crisis will happen. As sure as we are standing here today, market crises are not a case of if, it's a case of when. They'll happen. We just have to wait for them. And you know what? You might end up paying a slightly higher price. In other words, let's take, I don't know, stock X. It's $100 today. It rises to 150, and you're like, man, I wish I'd taken that, bought that at 100. And then the market crisis comes and it falls to 110. And you're like, you see, it was cheaper at 100. You're not wrong, but that time period, the value of the company's increased. The company's not the same one it was when it was 100 Rand. So we need to find what we like. We need to find that price that we like. And then we need the discipline and the patience to wait. And so Buffett will sit on $250 billion of cash and say, I'll buy a little bit of Pool Corp, but I'm not doing anything big until something comes that I really, really like. And it's that patience and that ability. And to be clear, it's hard, particularly when markets are running and you miss. But what matters is know what you like and know the price, so that when we have Liberation Day and then the walk back, when we have a pandemic, when we have a global financial crisis, when we have whatever the next one will be, you're ready and you know what you want and you know the prices that you like to pay. That helps erode some of that fear you're going to see, because what's happening is markets are falling and the right thing to do in that response is buy, but what you really want to do is hide under your bed. Yeah, been there, done that. So another, and why did I, oh, there we go, up. Yo, this is shocking the heck out of me. 3 most important words in investing: margin or safety. And this alludes to what we were talking on the previous slide. That difference between ideally what you think it's worth, and then can you get it at even cheaper. So it's not just about saying, well, I think that, let's stay with Standard Bank a moment. Standard Bank, if we look at, and I'm using the price to book as a very rudimentary tool, Standard Bank price to book averages about 1.3, 1.4 over the long term. So at current 1.4 price to book, Standard Bank is fairly valued. But we want margin or safety. We want to buy it below fair value. We want to buy it at cheap value, which was the 0.9 that we saw earlier in the year. We want to buy it when it's cheap. We don't want to buy it at overly inflated prices. So we want to buy below that intrinsic, below that long term. And that cushions us for when we get things wrong. It cushions us for when things turn very ugly. And this is ShopRite, and I'll explain the chart in a moment. But essentially, this is the pandemic crash. And you could have picked ShopRite up for $100. Today, it's close to 300. Still not expensive. It's probably, I think 300 is probably fair, but you could have bought it for 100 Rand back in the pandemic. What was I doing? I was having an interview with Nessun Nair from Sasfin, asking if the new CEO perhaps wasn't up to Wati Passon. Instead, I should have just put the phone down, ended the show, and gone and bought some ShopRite. $100. And that, does it happen often? No. Earlier this year, ShopRite was 250. Was that cheap? Sure. But it's not, there's ShopRite at 150, sort of that point there. What you want here is high yellows and low oranges. So what have I got here? This is a very simple. This is 10 years of dividend yield, bottom line, yellow line. Blue line is 10 years of PE, and orange is 10 years of forward PE. PE is price divided by earnings. So value, it's a metric of valuation. Forward PE is price divided by next year's earnings. Now we have to guess what next year's earnings will be, but in the case of ShopRite, take last year's earnings, add 12%, you're going to be in the ballpark. ShopRite's, they're good at what they do, but they're never going to surprise us massively and come out with 30% earnings or something like that. And what I then do is the parallel dotted lines. The middle one is the mean over the period, and then one standard deviation above, one below. But what you've got here is your dividend yield. You want to buy it standard deviation above, and on your PE, standard deviation below. ShopRite is often giving you opportunities, none as good as the 100 Rand back in the pandemic. Would I buy ShopRite at 300? No, and partly because, okay, disclaimer, I own ShopRite. I have enough ShopRites. I don't want them at 300. But at 250, yeah, I bought a few, not many, just a couple. I had some extra cash. ShopRite was 250, thinking to myself, that's not bad. It's not a shabby, it's a solid business. We'll come back to its moat in a moment. But it's that finding those companies that you like and knowing where that price point is. This I'm creating from a software package called a website called Koifin. You can grab it from many places. You can get the raw data and run it in Excel. It's easy enough to do. As I said, you can get more fancy and do discounted cash flows and all of those sort of things. But something that gives you a metric. And I got to say, in many ways, if we're talking about the rationale of a business being to make money, cash, and for an investor to get that cash back in dividends, maybe it's just the dividend one that really matters about. That when the ShopRite dividend was probably 3 standard deviations above the 10-year average, which in this case is 2.54, which is exactly where it was this morning when I pulled that chart. When it's 3 standard deviations above and your dividend yield is probably spiked to 3.8, well, you buy it. Because if nothing else, you're earning 3.8, growing ahead of inflation for as long as you hold that share. This comes from not knowing what you're doing. I don't know how many of you are on social media or were on social media over the weekend. I mean, social media is bad for your health, and social media on the weekend is worse for your health. But there was a collapse in markets on Friday because Trump tariffs China. Crypto fell 10%, and people on a 10% collapse in crypto lost their entire net worth because they were geared 10 times. Now, firstly, you never gear 10 times. For those who are saying you don't understand, what I mean by that is you had 1,000 Rand and the bank lent you 10,000 and you put 11,000 into an investment, which sounds really cool because you got all the bank's money, but then it dropped to 1,000 Rand and the bank's like, yeah, we're closing your position, you've got nothing left. Couple of things. A surprising number of people had all of their net worth in crypto. I mean, that's not brave, that's just stupid. Secondly, a bunch of people didn't understand, it would seem, how gearing works, that it's great on the way up, but it's very ungreat on the way down. And thirdly, you don't gear something that is volatile like crypto. Crypto is a geared, effectively, it's a geared call on the S&P. You don't need to gear it more. It's already got massive volatility and bouncing around, etc. So we need to know what we know, and importantly, to quote Dick Cheney, we need to know what we don't know. That matters a huge amount as well. Volatility isn't risk, ignorance is risk. I would say the biggest risk to my portfolio is me. Seeing ShopRite at $100 and deciding that I was worried about Peter Engelbrecht rather than going click on my online brokerage and buying some more. Stay with your circle of competence. Stay with businesses that are simple. And there's a lot of very complicated businesses out there. Insurance being one of them. Discovery. Man, I mean, I'm not an accountant, so balance sheets and cash flow statements, I can do it, but I'm not the expert in the room. But then I read the Discovery stuff, and I just don't know what they're saying half the time. They use words and phrases and numbers, and I'm just left. And then eventually I get someone smart on the show, or I just look at the price. Oh, it's going up. This must be good. Oh, the market likes it. People smart. And maybe everyone's just looking at the price, and we're all just lying to ourselves. But with that circle of competence. And to be clear, our circle of competence is going to start small, and it will grow. But think about it. I mean, retail, easy, right? Retail. You buy stuff or make stuff, and you sell it at profit. You've got to have the right stuff at the right place. You've got to be able to sell it at a profit. You've got to do marketing. You've got competitors. But in essence, being a grocer, ShopRite, is easy. Banking is kind of easy. You take deposits, you lend money, make sure that you don't get too many bad debts. It's got more complicated these days with CIBs and all the other sorts of things. But in essence, banking is a simple business. Mining is a simple business, although deeply cyclical. Insurance is hard. A bunch of these tech stocks, their business models seem simple, but I mean, NVIDIA, they make stuff that makes AI. That doesn't explain what NVIDIA does. That sort of thing. So, as an example, Buffett avoided the dot-com stocks in 2000. He was just like, I don't understand this. I don't know what's happening. I'm staying away. In hindsight, an excellent choice. He talks around a moat, and I'm going to talk about that. We were having a debate earlier in the week, me and some folks. Does NVIDIA have a moat? That moat is like a castle, right? You've got a moat around it, and it keeps the invaders away. Does NVIDIA have a moat? No, it has an advantage. That advantage is that it got out of the blocks first and makes the best chips available. And I would argue the same for ASML. I would argue the same for TSMC. They have an advantage. It is a significant advantage. It's making them a vast amount of money. But let's not pretend there isn't somebody who in the next 1, 5, 10, 20 years will do a better ultraviolet lithograph than ASML, or a better Blackwell 400 than NVIDIA. That will happen. That we have to accept. And then NVIDIA tries to stop it. They've got their own proprietary code that you use to run their chips. I hear all of that. But if you go and read the results from the likes of Amazon, from Microsoft, from Meta, and from Google, these are the biggest customers of NVIDIA. And what are they all doing? Making their own chips. Not as good as NVIDIA, but one day somebody will get an NVIDIA chip, and it won't be NVIDIA. So it's that, my area of expertise, am I able to fully understand the NVIDIA advantage? No. Do I know that the market is loving it and I would like some of that action? Yes, and I'll come to that in a bit. But be comfortable watching stocks, investors making money in areas you're not invested in. In other words, careful of the FOMO. Careful of the, well, everyone's over there. I don't know what's happening over there, but let me go there too. It might be a snake charmer's party in your lunch. So know what your area of competence is, know what you know, and be happy with what you don't know, and then always be learning. The point with our circle of competence is it grows over time, and we can expand it, and we could particularly go, I downloaded Llama onto my Mac and was running that for a while. Llama's the Meta freeware large language model, just so that I could have a better sense of what these LLMs are really doing. The problem is it runs on Python, and my Python is terrible, so I had to take it off because it kept on crashing. But it's like I'm looking at this, and I don't have a much area of expertise, but I can learn. Might not become an expert, but I can certainly be smarter than I am today, and that's hugely important. His favorite holding period is forever. And I know this is a cliche, and I know we all buy stocks and say, yeah, this one forever. And then something happens. I don't know, you need money for a holiday or a wedding, or you need, you want to buy another stock and you haven't got money, or whatever the case is, and suddenly that forever is like, yeah, next time. The true power of markets is that ability to hold for ages and ages. ShopRite is a deeply boring, uninspiring stock. I bought my first ShopRite at about 8 Rand a share about 20-ish years ago. I'm probably going to get, I can run the numbers, I'm going to get about 8 Rand a share in dividends this year. Whereas I'm going to get my full purchase price back in one single year. And that dividend will go up every year. And of course, I've got 20 years of dividends behind me. And the secret there is not that ShopRite is exciting. It's not that ShopRite is, it is innovative, but not in the sense that it just sells groceries. It does it in clever ways, but it just sells groceries. Point is, I bought the best grocery retailer in the world, to be clear. Of all the grocery retailers on planet Earth with more than 1,000 stores, ShopRite has the biggest margin by a factor of 2. Their operating margin is about 5.5. The next best is 2.8. They're the best in the world, and we can buy them on our little JSE. And the share price is up nicely, but I mean, no one got rich over the weekend on ShopRite. You can on others. So it's that forever. It's that own, don't trade. And that's such an important point that I'm going to come back to, but I want to still now. When I started in the market way back in the day, and you bought the shares and you phoned your broker and sent them money, and then they sent you a letter with a share certificate. And that was your proof of ownership. And when you wanted to sell, you had to post them the share certificate, and they would dematerialize and sell. And now it's all electronic. Now it's all click, click. There's no tangible to it. But at the end of the day, we're buying businesses. Yeah, if you're buying Bitcoin or gold, you're not. But if you're buying a company on a stock market, you're buying a business. You now own some of that business. And we need to bring that back into our investing. And remember that we are shareholders, and that shareholders are ultimately business owners. And it's not like owning a pizza parlor where I've got to go around on Friday evening and make sure they've got enough flour and cheese. It's a passive ownership. Now, every morning, 120,000 people wake up and go work at ShopRite across their different brands and divisions, and I don't have to do anything. But I still need to be treating it like a business. And I'll come to some of that in a bit. But it's own, don't trade. Buy it, hold it, don't sell it. When it's expensive, so what? The temptation that it becomes expensive and so you sell it. Well, now what? Now you don't own it. Now you've got to buy it again. Is it going to get cheap? What about just buy it and hold it, and hold it forever in an ideal world. So because they compound, they absolutely compound. You know, it's small little growths. You know, 10% growth a year is not thrilling, but it means it's doubling in 7.5 years. 15% of growth a year is kind of exciting. 15% a year doubles in 5 years. That is huge compounding. Now your $100 becomes 200, and then 400, and then 8 and 1600. So in 20 years, 100 Rand is 1600. And I know there's inflation, but you get the story of it. So great businesses compound, which is in part why Berkshire never pays dividends. He writes about it in his 2012 letter. It's worth going and having a read. But what he says is, like, if you want cash from your Berkshire, sell shares. He says, I'm not giving you dividends. This is in my company, and yes, I've got 350 billion of cash, and he will buy back his own shares, the Berkshire shares, if they're low enough, but he's not distributing dividends at all. He says, this is my money to invest, and we need to think about that as well. Looking at your investment account as something which you can tap into for cash flow needs, holidays, weddings, motor cars, whatever the case may be. It's a terrible idea, because that 100 Rand you took out today for, to go and get a burger somewhere, it's 1,600 Rand in a couple of decades. And you've basically that most expensive burger you've ever bought. So we need to look at our portfolio as that business which I was referring to. We are owners of it, and this is our portfolio of companies that we own. And we don't take money out. I appreciate emergencies, different story. Ideal world, we've got an emergency fund. But if you look at Buffett's wealth, make no mistake. I mean, at age 52, someone said to me, he's only worth 300 million. He's only me. But look where that real growth comes. 94. So let's say in 30 years, he goes from 17 to 140 billion. Yeah, the growth was slow. At 21, he's worth 20,000. At 26, he's worth 26,000. And then I think he robbed a bank, because then he's worth $1 million. I'm not sure what happened at that point, but you get the point. And it's frustrating. Portfolio is growing slowly. It's going nowhere. Warren Ingram wrote a book a couple of years ago, Your First Million. Man, that first million is hard, because you started with 0. Your second million's easy. Easier. Why? Well, because you've got $1 million and you're probably earning 50,000 in dividends every year. So, well, bang, it's going to double on its own anyway. So it is hard and it is stressful. But another quote which I haven't used, which Warren Buffett has said before, buy a stock that if the market closed tomorrow for a decade, you wouldn't be stressed. And that's the one, when I'm doing that click on the OST platform, and then it pops up the, are you sure? And I'm like, hell no, man, I don't know if I'm sure. Please don't ask hard questions. But when I'm doing that, it's always to me, and that mantra goes through my head. Am I prepared to hold this for a decade? If OST phones me tomorrow and says, we've got a system problem, you can't solve for 10 years. Would I be comfortable holding this when I can't sell it for 10 years? And if the answer is, well, then why am I buying it? Then I'm trading. Trading's got a place, but it's not your long-term boring portfolio. Your long-term boring portfolio is stuff that you buy and you will just hold forever and a day. It'll go up, it'll become expensive, it'll go down and become cheap. You don't care. The question is it a good quality business? Is it generating cash? Is it paying you dividends? If the answer to those are yes, you just carry on holding it. Be fearful when others are greedy, and greedy when others are fearful. Easy to say, hard to do, for bunches of reasons. I wanted to go back to that. Bunches of reasons of why it's hard. The one is things are falling. You're like, is this the end of the world? Top tip, if it's the end of the world, it doesn't matter what price you paid because the world's about to end. You're worried that it's going to go lower. Okay, it might go lower, but if that's the price you pay, be happy with it. If you want to be clever, I've tried this, very limited success, so I don't recommend it. You want to buy at 100, gets to 100, well, buy half the position and see what happens. $10 says it'll go up from there, and the other half you'll pay at a higher price. But if that manages your emotions, that's fine. But the market gives us opportunities, and not many. To be very clear, not many of them. If we go back the last 20 years, the 08-09 collapse, market was down about 45, 50%, depending where you were. Humongous opportunity. I was buying shares. I've told the story before. I'll tell it again quick. I was at Standard Bank. You get bonuses paid twice a year, March and September. So I bought in March of 08, things went lower. I bought in September 08, things went lower. I bought in March 09, that was the bottom. I didn't know that, but 2 years later, every one of those purchases was in the profit. Every single one, even the ones that I'd bought and watched it fall lower still. Standard Bank was a 70 Rand share back then at the worst of the crisis. Now it's what, 350? Now, again, boring bank, fivefold. So, come on, clicker, play with me. Markets are moody. We must use that in our favor. Not buy when things are high, but when we get those collapses. So the 08-09 crisis was a great opportunity. There was some serious wobbles around 2014, particularly in terms of it was the whole quantitative easing, then Fed chair, basically quantitative kitchen sink, everything, just quantitative easing infinity. Lots of panic there. But even expensive stocks become cheap at some point. Alphabet earlier this year, parent company to Google, was on a PE of 16. The S&P was on 23, but Google is growing, Alphabet is growing at twice what the S&P is. That was a cheap stock. It subsequently subsequently run. It's now on a PE of around 23. It's probably still cheap, but there was a serious opportunity there when, and the reasons were quite simple. They have a number of court cases, anti-competitive court cases. People were worried that they were going to lose them. Their Gemini launch, which they did in, was it early 24 for their AI, was a joke. I mean, it was just a joke. I mean, they faked some of it. It absolutely was a mess. There was a bunch there that you could say, but it's Alphabet, it's Google, it's YouTube. You know what the most watched thing on TVs in America is? YouTube. Not Disney, not CBS, not Netflix, it's YouTube. And that little YouTube sits in there. Waymo is driverless cars. The set of results back in March, they were doing 250,000 trips a week. So the market will give you collectively, it will sometimes collapse. We had the pandemic collapse. We had a fair bit of sell-off earlier this year, back in, as I said, April, Liberation Day, and then the reversal from Trump. But individual stocks will also give you sell-offs. Richmond has been coming down a whole bunch recently. Now, it rallied hard yesterday in the back of LVMH numbers, but Richmond was potentially, go look at a Richmond chart. It runs, and then it just goes down, 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 until everyone is like hating of luxury, and then it runs again. Race, Ferrari, lovely stock, lovely. Ferrari's business model is quite simple. We make less cars than the public want. Why? Because it makes demand. You want to buy a Ferrari? First, you go buy a second-hand Ferrari. Then you can come and buy a new Ferrari. They do special releases. Oh, but you only own 3 Ferraris. You don't qualify for this one. Their biggest trick is that if you want to pick it up at the factory and do a tour, they charge you, I think, an extra $10,000. People do it to pick up your own stuff. No, you pay for delivery, not for collection. It's like, Yeah, it's like ShopRite saying, yeah, if you come to the shop, we charge you more because, man, you're in the shop. And what did Ferrari do? They had a capital markets day earlier in the week. They told the world that they're going to be growing a little bit slower, and so the stock is selling off. Is it currently cheap? I don't think so, but it might get there. Ferrari is a company I would like to own. I understand the business. It's red cars that go vroom, 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 except when they're doing F1, in which case they go vroom. I've been a Ferraris fan since Jody Scheckter, man. It's been a rough 30, 40 years. There have been some glimmers, Jody Scheckter, Michael Schumacher, but mostly it's been pain and suffering. It's a brilliant company. It has a product that is instantly recognizable and highly desirable. But I need to pay the right price. And I've been waiting, 2, 3, 4 years, and it's been expensive the whole time. I won't pay a 36 PE for a car company, but one day it'll come to a price that I like. So know what those stocks are. And as I said, sometimes the market collectively collapses, and other times it's individual stocks that collapse. Capitec, when they had the Viceroy story that came out, Capitec had been trading at 1400. The Viceroy short seller report comes out, the stock crashes down to 715. There was a window for you. Back in April, when we were having the Liberation Day tariff disaster, Capitec was 2,400. Now it's back. Buy some more of that world. Two things. Firstly, as I said earlier, if the world is ending, nothing else matters. What share you buy doesn't matter. Secondly, if you come in prepared, in other words, you know the stocks you like, you know the prices that you like, you know that a financial crisis, as we saw in 08, is a horrific thing, but you know that the world will recover. Will it take a year? Will it take a decade? Don't know. Will it happen? Yes. We know that the pandemic of 2000 was an absolute horror, the first in a century. We had no idea what was going to happen. But we knew that we would get through it. We didn't know how long it would take. We didn't know how bad it would be. And to all the folks out there saying, yeah, but maybe we didn't get through the pandemic. Well, that's also fine, because then we're all dead and it doesn't matter. That's my not so bright view on life. The point is, know what it is that you like. Know what the stocks are. Put alerts, put trigger alerts, so that when prices are hit, boom, your screen lights up. That helps remove some of that fear. And then the key point is to remember that you're going to hold this for a very, very long time. And if it does take however many years to recover from whatever the said crisis is, you've got time on your side. But you've bought a great company at a great price. And those are your first two rules of investing. Saying no. Saying no is hard. Everyone will tell you, businessmen, investors, businesswomen, everyone else will tell you that the biggest asset is the ability to say no. In this space, in the investing world, it's that ability to say no to investments, to look at something and say, it's expensive, it's outside my area of competence, I don't believe the investment thesis. And again, you might be wrong. I said it right up front. Being wrong is not a bug. In investing, being wrong is a feature. It's going to happen. But remember, the worst thing that can happen when you buy a stock that is terrible is it goes to zero. And you lose 100%. And that is terrible. Make no mistake. But when you buy a great stock, it can go up infinitely. There's no cap on the upside. There is a cap on the downside. So you have asymmetry of return. You can only lose 100%, but you can make hundreds, thousands, tens of thousands of percents on the way up. So the losers are no fun. They're bad for the soul. They make you doubt your ability. But if you've got a well-structured portfolio, they're not going to be onerous and they're not going to be game over. Not like the people who were 10 times geared in a B-grade dodgy crypto coin on the weekend. This is ChatGPT playing the asked him for a South African Test cricketer. I don't think he knows what cricket or South Africa is. So wait for those fat pitches, Buffett's phraseology, because of course they are baseball. Avoid distractions and fads. Don't chase. Rather miss a stock than overpay. Here is Microsoft. The reason I show you Microsoft is there is the dot-com peak of Microsoft 16 years before it gets back. At that point in time, now frankly, that's Steve Ballmer. Sorry, Mr. Ballmer. But back at that point, at the dot-com peak, they had Windows, which was on 85% of PCs ran Windows. Linux hardly existed at that point, and no one bought a Mac because Macs were just horrible, unreliable, and the company had to be bailed out by Microsoft. They had Edge, the browser, the Explorer. It was, what was it called? Internet Explorer. That was it. And that thing had like 90% of market share. Now, sure, then the Justice Department came and said stuff. It had Office, which was on every business computer in the world. It had killed Xyrite and Lotus 123 and all of those other things. And today we have free software for Office, right? We can get Libra software. We can get the Google Sheets and Google Docs, etc. And in the corporate world, what is Microsoft's Office dominance? Plus 90%. There was a compelling reason for Microsoft in that dot-com era to be a brilliant company. But there was no reason to pay that price because it was 16 years before you saw it again. Sure, you got some dividends along the way, but 16 years. If you had just waited for the crash, you would have picked it up a year and a half later, and you would have been in profit the entire journey, except for small blip. There's a small blip somewhere. No, I can't find it. Oh, the financial crisis, of course. So just that small matter of saying, I don't like that price, I will wait. You get in at a better price a year or two later, and suddenly it's a whole different investment. So it's about that waiting. It's rather miss than overpay. You pay too much for a stock. Where's your return coming from? You buy a high flyer on a 50 times sales. It's like your ability to profit from there is really, really tough unless that company can double in its sales, repeatedly. And to be clear, a new startup, Palantir, those, yes, they can. We'll touch on them in a moment. The early stage startup businesses. But I mean, OpenAI right now, they're doing a round of letting the staff sell shares. They've valued it at 500 billion for the purpose. Revenue this year is going to be 12 billion. There's a way they fudge the revenue. They call it smoothed revenue, which means they go back over the last year. They pick the best month and multiply it by 12. I'm like, well, why don't you just take the last 12 months and add them together? People are like, don't be silly. The number will be smaller. I'm like, but the number will be honest. Anyway, so they're paying, so they're doing, let's call it 10 billion because it's easy math. So basically you're buying it on 50 times sales. I mean, I don't know. I mean, I love AI, but I don't know that I would want to buy OpenAI on 50 times sales. They need to get their sales bigger than the entire SaaS industry, software as a service. AI needs to be 2 to 3 times. This is a research report from Morgan Stanley. AI needs to get to 2 to 3 times SaaS sales to justify current valuations. Can it? I don't know. Would I be buying OpenAI at $500 million? Yes, speculative. Long-term portfolio? No thanks. No thanks. Most important investment you can make is in yourself. And that is that continual learning. Read, learn, improve. Read annual reports. Read investing books. Read general nonfiction. Heck, read fiction as well. But go and read books on how we learn. Go and read books on how to manage emotions. Go and read books on how we process information. Go and read books on, just read stuff. Some of it, annual reports and results, might be beyond us at the point because we're not all accountants. But again, it comes with time. We're all smart enough to understand how a balance sheet works and a cash flow statement. The first time we see it, no. But by the 3rd or 10th or 50th, you might be a slower learner like me. It starts to make sense. You start to know what those red flags are. Buffett reads all day. Basically, Buffett's job is 6 to 8 hours of reading a day. Problem is we have jobs. We are not afforded that luxury, but we can do shortcuts. For example, for your investing in nonfiction, sign up for something like Blinkist. Blinkist takes a book and gives you a 15-minute summary, either audio or read. So I sometimes can read 4 books in a day. Have I read them? No, but I've read enough to know if it's worth going and reading the entire book, if there's stuff in there that I really... Sometimes you read a 15-minute review of a book and that's it, you've got the story. Nassim Taleb's Black Swan. That book really should have been 5 pages. But of course, you can't sell a 5-page book. That's called a pamphlet. So then he writes an entire book. And at the end of it, you're like, yeah, but I think he only said one thing, which is we don't know what we don't know, which is perfectly true. But like AI summaries of annual reports. Use something like Notebook LM, which is a Google document, Google AI. What you do is it's not a large language model. It's a small language model. So you load documents into it. So for all of the shares that I'm invested into and for all the shares that I'm interested in investing into, I have a bucket at Notebook LM. And I drop in the annual reports, I drop in the results, I have the links, because you can put documents in, videos, and you can put websites. I have links to the different websites. I'll take big interviews that the CEOs do or that analysts do. I'll get analysts, and they're all then dropped in there. And now I can query it. I can now talk to this and say, hey, so, you know, what's their forward prospects? What are they saying about this? What are they saying about that? And to be clear, AI lies. They call it hallucination. When I was a kid, they called it lies. But there's a trick for that. So when you're querying it, you say to whatever AI you're using, you say, for every point you make, I need a reference. I need a document. I need a website. And I need you to give me the paragraph number that you've taken this data from. Then I go to Claude or I go to ChatGPT and I drop it in there and I say to Claude and ChatGPT, please check these references for me. But if the first AI lied, I mean, maybe the second AI lies too, but I'm narrowing that funnel. You know, if they both lie at 70%, well, they both lie a third of the time, by the time I've used the second one, I've got a 95% accuracy. So we can crunch, we can compute, we can go through a lot more data these days than we could in previous times. Emotional control, more important than IQ. It's not necessarily the smartest person in the room who makes the most money. It's the person who can manage their emotions, the person who can manage their process, the person that's happy when the world is crashing and markets are screaming red, who goes and says, ooh, it's on sale, and goes and buys stuff instead of panicking. Determining the competitive advantage of any given company, the durability of that advantage. So it's not just about having an advantage, which matters. It's about how is that advantage going to look in a year or 5 or 10. And that is a business's moat. That moat is what keeps competitors away. I said earlier, and I say it again here, NVIDIA, ASML, TSMC, they don't have moats, they have an advantage. To be clear, there's money to be made in an advantage. But one day, NVIDIA is going to miss on earnings. And that share price will lose 40% and might not recover for decades. Moats are barriers to entry. Brands, Coca-Cola, Apple. Apple's moat, a couple of things. Once you're in their walled garden, it's like Hotel California, you can check out, but you can't leave. They have 2 billion people on their apps spending money, so on their devices, spending money on apps. They do make great product. When I got my first, it was actually an Air, Apple Mac Air. It was the lightest, fastest, most amazing computer I'd seen in my entire life. You can now get that MacBook Pro M something, I don't know, it's 2 or 3 years old. You can get a Windows machine as good, as fast as everything. But I'm in the Apple ecosystem now. They've got me hook, line, and sinker. And that is immensely powerful. You know, when they have new earbuds, man, I want those earbuds. They have new this, new other thing. I mean, I've gotten smarter. I don't go and buy everything anymore. I used to. But it's that moat. The moat with Coca-Cola is brand. No one's saying that Coca-Cola is a great drink. No one's saying it's a healthy drink. No one's saying it's good for you or the planet. But you can go anywhere in this world and you say Coca-Cola, and the person on the other end of the conversation might not speak your language, but they know what you mean. And they can probably get you one within a couple of minutes. The value of that, I don't think we can add a value to it. We absolutely can't. Looking in the South African space, so there were two. So ShopRite, does it have a moat? I'm not sure it does. I think it has an advantage. It has an insane advantage in that it's more profitable. Customers are immensely loyal to it. How are they loyal? So if you go into a ShopRite, not a Checkers, if you go into a ShopRite, there will be R5 meals. Why? Because their blue-collar worker needs a R5 meal. And they will have a healthy meal for $5. And that person buying it knows that this is a loss leader. If you go into a Checkers, which is their higher LSM, they will have a R35 meal with a coffee. Same story. It's that brand loyalty. And then there's the 60/60s, and all of that is lovely. Then there's the unique clothing and the liquor stores, and all of those adding to it. Their key thing is their distribution centers. But trust me, Pick n Pay is building distribution centers. They're just 20 years late. And by now, ShopRite is way down the road. But once upon a time, back in the 80s and 90s, the bluest of blue chips on our market was Pick n Pay. And then it lost its way. And how did we see it losing its way? Big dividends, no reinvesting back into the company. Whereas ShopRite was exactly the other way around. Small dividends, pouring money back into the company. So I don't think ShopRite has a moat. I think it has an advantage. I think Bidcorp might have a moat. So Bidcorp, food service, distribution. They operate all over the world, not so much in North America, but otherwise they're in pretty much other. If you had a biscuit back there earlier or put a bit of sugar in your coffee, etc., that's Bidcorp's providing it. They little sachets of sugar, but if they make ½ cent per each, but you sell $1 billion a year, the numbers start to add up. They'll sell you fresh lettuce. It's all of that. They're servicing predominantly the catering industry. And what it's got is scale. And that scale becomes hard to replicate. Scale gives you logistics. It means that when your customer's buying lettuce here and sugar from there and pineapples from there, Bidcorp comes and says, guys, come on, we can do it for you all in one box, one delivery, make your life easier. And because we got scale, boom, we'll give you price at the same time. Is it an indefensible moat? No. Is it a strong moat? Absolutely it is. And it is also less volatile and quite niche, as opposed to your techs, and tech was just the one example I threw out. Another one I would argue, I mentioned Ferrari earlier, I'm going to stay with luxury, Richemont. Cartier bracelets, 9,000 a pop. To be clear, dollars, not ZAR. You don't walk into Cartier with ZAR. In fact, you don't walk into Cartier, you queue. Then they let you in. We were in Paris. You're driving, you're in a bus. You see a queue of people. What's that? Oh, Cartier. People are queuing. People in China fly to Paris to queue because they don't want to be seen queuing back at home in China. I don't understand luxury. Let's be clear. The suit is old. My shoes are old. It's pretty, but I'm not spending money on it. I'm not that silly. But there are people who do. Absolutely, there are people that do. And sometimes the world is ending and they're feeling poorer, so they buy less. And then sometimes the world isn't ending and they're feeling richer and they buy more. And to be clear, when you're a 1%er and you're worth, I don't know, $2 billion, and the market goes down half and you're now worth $1 billion, what changed in your life today? Because you're only worth 1 billion instead of 2. You probably didn't buy a Cartier because you're feeling quite poor, but you're not poor by any stretch. Moat. And what really matters is it is about that durability of the advantage. Now, can anybody make a $9,000 little bracelet? Yes, we could all do it. But who's buying Simon's super expensive bracelet? Cartier has 100 years of making it, maybe longer. Rolex, all these crazy luxuries. And when I talk luxury, everyone loves LVMH and the like. And I'm like, you know what? Hennessy is not a luxury, it's a drink, with respect. Proper luxury is stuff that most of us, like when we look through the window, they say, no, dude, no looking. Looking's only free if you're rich, and you're not rich. Back to the key point. I started here. Businesses, not stocks. Think like a business. Attend the AGMs and vote. OST lets you do it online, nice and easy. Most AGMs these days are virtual, so you can do it that way. Understand how the business makes money. You wouldn't buy a business blind. You would, if there's a pizza parlor for sale down the road, you know how they make money. They sell pizza. But hang on a second. You need to know more if you're going to be investing in that pizza parlor down the road. Make sure you understand it. Act like a partner, not an outsider. Site visits. I remember I used to hold famous brands, and Keith McLachlan and I would do site visits, otherwise known going to one of their bars and having a drink. Except we started going to some of their bars and having a drink, and we were like they haven't got stuff on the menu. And like this bar is like tacky and dirty, and their fancy beer list, 4 of the beers are out of stock. And that happens 2 or 3 times, and we're like, yo, hang on a second here. I mean, is this an isolated experience? Don't know. We were only going to bars around Johannesburg. But then you start seeing the numbers, and you're like, yo, actually, 2 plus 2 does equal 4. They've got problems here. Product experience, Google Alerts, annual report, CEO interviews. If you invest in a company, you should have a Google Alert on it. I've got a Google Alert on ShopRite. It's a pain because I get sometimes like 5 emails a day, but it means there's something's happening out there. I'm aware of it. Now, my job is to watch markets, so I am, but for most people, this is not your job, and so this is where it comes at you. And Google's easy. It just gives you a list of all the links, and you can decide what you do and what you don't care about. It's that owner's mindset. You own a slice of the business. If you owned a pizza parlor, you wouldn't not ever visit it. You would drive past late on a Friday evening to see how busy it is. You would drive past early on a Saturday morning to make sure they're doing the dough, etc., etc. You would be active. Be active here. Vote, have your say, ask questions, be involved. Buy a wonderful company at a fair price and a fair company at a wonderful price. The temptation is we look at something and we say to ourselves, you know what? ShopRite's number 1, I'm going to buy number 2. And at some point that might work for you, but at every point in the last 20 years, buying Pick and Pay instead of ShopRite was a terrible idea. If there's a horse race out there, and 50 yards before the end, I freeze time and I say, place your bets. Do you place your bets on the horse that's in the front and gaining? Or do you go all the way back to the start where some horse like fell asleep and say, you know what, that horse might wake up. It might have a turbocharge. It might beat everybody else. No, you go to the front and you say, winner, winner, chicken dinner. I like winners. You know what? Winners know how to win. Winners use their muscle to muscle second place. I've worked for businesses that are winners, and I've worked for businesses that are number 2. The problem with number 2 is twofold. Firstly, I need number 1 to stumble. And secondly, the whole time I'm chasing, number 1's just hitting me on the head. Here's a special price. Oh, you discounted milk. Nonsense. We're going to give free pizzas. Constantly banging you back. So it's not just that I need them to stumble. It's like I need to get through this maze of chaos that they're throwing at me at the same time. Avoid the temptation to go second place, buy the best, buy those that continue to win. Always buy the winners. Apple versus everyone, ShopRite versus everyone. Second place, Coke versus Pepsi. Coke and Pepsi have been in battle for 100 years. Coke is so far 100-0 on that score. Sure, Pepsi's fine. Sure, Pepsi makes money, etc., etc. But no one ever pretends that Pepsi's overtaken Coke. No one looks at it and says, one day that'll happen. Will it? Sure, it could. It almost did when they did the Coke new recipe back in the 80s. the winners tend to win. The Lindy effect, and I stole this from Pete Fullen's newsletter. The Lindy effect. So we're talking non-perishable ideas, books, cultural. The longer it has existed, the more likely it will continue existing into the future. Think about BlackBerry. And the youngins are like, what's the BlackBerry? Exactly. It was the biggest phone in the world for 4 years. Now they do car automation software. That's it. Find those that have got the proof in the pudding. Ferraris, Cartiers. Those that have shown how they can do it, because probably they will continue. And I say probably because there's no certainty. Things can fall over, things can go wrong. 2 slides. Temperament, not intellect. It's not the smartest person who wins this game. It's the person who can do the right thing at the right time for the right reason. Hard. But is it that doing the right thing at the right time for the right reason is something that every single person in this room has the capacity to do? We don't all have the capacity to analyze a balance sheet like a pro. Some of us are better than others. But right thing, right time, right reason, we all have that skill set. We have that ability. Emotional discipline is beating your IQ. Stay calm, rational, and be consistent. Consistent. One of my biggest challenges has been lack of consistency. I do spur of the moment. Buy something on the spur of a moment. Sell something on the spur of the moment. None of those have I looked back with fondness. So it's like, was I drinking that early on a Tuesday? Surely not. But you never know. You never know. So it's no FOMO. It's no patience. It's have that patience. Know what you like. Know the price that you like it. Right thing, right time. And then the key thing. And I've been talking this evening about a very, I want to call it bog standard method of investing, right? Back to basics. There's no secret sauce with Warren Buffett. Buy the quality at good prices, hold it forever, accept you'll make mistakes. Don't let your emotions rule your decisions. Truthfully, your portfolio is not going to look just like that. You're here this evening or on the webcast because you want a little more zhuzh. You want to own some gold. You want to own some NVIDIA. So how do you structure a portfolio? This 15 to 20 stocks in a core portfolio is all you need as an individual. 15 to 20 stocks that meet that requirement. It might take you 5 years or longer to build it because you might find a stock, but now you've got to wait for the price. And that can take time. So 15 to 20 stock portfolio. Over and above that, you've got your Reg 28, you've got your tax-free, then add a few exciting, risky ones. 3, 4 stocks, maybe 5 if you really want to go big. Some NVIDIA, some Palantir, whatever the case may be. Those ones which are either going to hit it out the park or crash and burn, or hit it out the park and then crash and burn. And if you're like me, you're the whole journey, man. You'll go out the park, you'll soar, you'll crash, you'll burn, and you'll still be holding on. Like, why didn't I sell there? You know why? It's like gold. Should I be selling my gold at 4,300? I don't know. I mean, I don't know. So I'm not. If you want some flavor in your portfolio, sure, absolutely. I'm not here to say don't. Certainly, there are some crazy numbers that you can do there. And if you were one of those who bought the NVIDIA at the equivalent of $2 a share and now it's $180 a share, don't do what I do. Sell some of it and bang it into your boring portfolio. And take some of it and take your loved one on a holiday and buy some overpriced whiskey and hot dogs and stuff like that. But focus on that core, boring, very long term. It's not hard, but it does take time. That's me. We've got 2 more presentations in 10 days. We've got the OST to shift, and then 8 December position portfolio for 2026. You'll get emails about those. I've run my time, but I promise to take some questions. If you need to leave, I appreciate that. It's my fault, not yours. But if there are some questions, I'll take 2 or 3. Trailing stop loss. No, I tell you why I'm not a trading stop loss. Not in the, and I'm going to use my ShopRite as an example. So ShopRite was about 240, and then pandemic it went to 100. Wherever my stop loss was, I'm out. Now, would I go back at 100? Well, apparently not, because I didn't. So, you know, it's also trailing stop is then I've got the tax implication, and I hate making decisions based on tax, but it's not untrue. And do I get back in? That's always my worry. So when I'm in, I don't care about the price. When I'm in a stock, the prices of, sure, I mean, I monitor it. But what I'm really, really caring about is the numbers, the profits, the results. I own CMH. They came out with stellar results on Tuesday, I think it was. I hadn't looked at that stock's share chart since 6 months ago when it came out with stellar results. Turns out I should have, because at one point it was way down, but nonetheless. In between the results, not my worry. We'll park it there, ladies and gents. Really appreciate the time this evening, folks on the webcast. To those who come through to Rosebank, really appreciate the in-person. Have a good evening. Look after yourself, and if you can, look after somebody else as well. Cheers all.